Shea, and I was here last week, and we talked about credit and budgeting. The credit we talked about was more on the deposit side regarding check registers and when you were making a deposit to your bank account. This week, we're going to talk about credit on the borrowing side and investing. And the workshop that you are participating in is sponsored by Operation Hope. Now, before we get started, one of the things I noticed was I was giving you a lot of information, a lot of terms, and I'm sure you're quite familiar with most of the terms I gave you last week, but I decided to, because there's so many, to type them into a sheet that you can take home and keep in your nightstand or wherever as a reference. So here's a vocabulary list. If you would take one and pass it back, please. Thank you. Our objectives today are, as far as credit, we're going to learn what a credit card is and how it works. We're going to learn what a loan is and how it works. And we're going to learn what interest is and how that works. As far as investing, you may all be interested in investing, but I was talking to Sharon, and we're going to try to go over this section lightly because it is several years away, but at least we can give you the basics on investing. So we'll talk about the basic investment instruments, and we're going to talk about what's FDIC insured versus not FDIC insured. Before we go back, I want to ask you all, we talked about two things last week. One was the rules of the game. To be successful, we talked about fees, we talked about interest, we talked about credit cards, checking accounts. And the key for those were know the rules of the game. Because if you know the rules of the game, you're not going to get stuck paying bounce check fees or what have you. So that is the main focus, rules. And I also gave you a motto. It had 4 key words on it. Does anybody remember what that motto was that will help you throughout life if you follow it? Anyone? That's what I thought. So I brought it. So you can stare at it and remember it. Okay? It's the maze of life, the maze of financial security. Do your homework, do the research, question anything you do not understand. By doing your homework and questioning, you should get a variety of choices. From these choices, you're going to make a decision. You make the correct decision, you will gain dollars and therefore build your way towards financial independence. When you make bad decisions, it's going to pull you back. It's going to take you longer to get there. So if you remember the motto when you're talking about things, like what we're going to talk about today, loans, credit cards, they have to be researched. What is the best credit card to get? What's one with 0 interest? What's one with 15% interest? It's research. You have to do the work in order to make the best decisions. And this will follow you throughout your life on pretty much every decision you make. Can anybody tell me what the definition of credit is relating to borrowing money? Yes?
I think credit card is basically used for the money that you necessarily don't have at the time you pay back.
You're going to pay back. And you pay back over or time period. That's the key to credit. Paying back money in the future. It's not immediate. If you go to the store and pay cash, that's an immediate purchase. If you go to the store and pay with another method, which we're going to talk about next, that is not credit. I want to show you what these are. Types of credit. I have a red question mark because are they really types of credit? The first one is your ATM card. How many people in this room had an ATM card? One? One person. Okay. Here's my 2 cards. Would you say they look the same? Other than the color?
No.
No? What's the difference?
Freedom Chase and TD.
Well, they're 2 different banks, but do they look the same as far as the cards? Do you think they act the same?
Mm-hmm.
Yeah. How about you? Oh, yes? What do you think? Yes.
One's a debit card, one's a credit card.
Okay, what's the difference?
The credit card, you have to pay money back when the debit card comes out of your bank.
Very good. And do you have anything to add to that?
I was just gonna say, debit card is money that you have, so you don't have to worry about paying back later, and credit is like you're borrowing, like you say, a loan, but you have to pay for it.
Great. You know what confuses people? This is my debit card, my ATM card, this is my credit card. What confuses people to think that this is credit is you go to the store, you swipe the card, and you get two choices. Do you want to have it taken out as a debit, or do you want to have it taken out as a credit? Is that confusing? Of course. Because it's asking you, and it's saying credit. Don't be confused. This is not a credit card, it's a debit card. You need to have the money in the bank, otherwise we're going to get, does anybody remember what we talked about? Yes. An overdraft or a bounce check fee. And that's what you don't want because they're expensive. Now, credit cards and loans are somewhat similar. They're both types of credit, legitimate credit, because you're borrowing money, you're going to pay it off over a period of time. Credit cards are considered revolving credit. Revolving. They go round and round and round. You have what is called a credit limit, which we will get into next. But as long as you maintain your balance under that credit limit, you can continue to use that card over and over and over again. When you get to your credit limit, if you pay it off, again, you can use that card. That's revolving. The difference between a credit card and a loan is loans are usually more long-term, or let me say this, they're supposed to be more long-term. And it's one and done. You go and you get a car loan, the bank gives you, say, $25,000, you pay that $25,000 off after 5 years, it's done. You can't use it again. The only way you can get another loan is to reapply at the bank or the financial institution. Now the credit limit. Your credit limit is determined by your income, and it's determined by, which we mentioned briefly last week, your credit score or your FICO score. And there are 5 categories that make up your FICO score. The one that we're going to talk about is how you pay your bills. That's 35% of your FICO score. If you pay on time or if you pay 1 day late, it doesn't matter. So what the company is going to do, the bank is going to look at what your income is. They're not going to give you a $10,000 loan if you're making $1,000. Okay? They're going to look at your FICO score, and those 2 pieces of information are going to determine how much credit they're going to give you versus a loan or a credit card. Now, interest. For the banks, this is how they make money. The banks make money charging fees and charging interest. The fees, you don't want to pay. There's no reason to pay a fee if you follow the rules. Interest is not bad. It's money you're paying, but if it's for a purchase that's very expensive, like a car or a house, most people don't have the amount of cash to just go and pay for the car or pay for the house. So to go and get a loan and pay interest is not a bad thing, even though you're paying money to the bank for their use or your use of their money. The rate for the interest is annual percentage rate. So you may see APR, and that's what it means. That's the rate that you will be charged.